Hello everybody, this is Books of the Stock Market. How's everyone doing? As for me, I came back from my morning run and it was not cold, but there was no sun, so that was unfortunate. Also, I've been working on my audio setup so I can produce higher quality videos, and there seems to be some audio popping sounds in the raw unedited footage of the video. So after some Googling, I found out that I would need some sort of audio diffuser. But instead of buying one, I learned about a hack where if you put a sock over your mic, it may act as an audio diffuser. So that's the setup I'm currently working with. Hopefully the audio quality gets better. And other than that, I do not have any other interesting news. So I'll move on to the reason you guys clicked this video. So in the last video, we learned the basics of charting, and this week we will learn the fundamentals of trends, support, and resistance. Let's start off by defining what a trend is. A trend is defined as the overall direction of the market. So trends are made up of multiple peaks and troughs, and these multiple peaks and troughs combine into the overall trend. An uptrend is a type of trend that has a series of consecutive higher peaks and troughs. So in simpler terms, this basically means the stock makes a higher high and a higher low. A downtrend, on the other hand, is a type of trend that has a series of consecutive lower peaks and lower troughs. In simpler terms, this means the stock makes lower lows and lower highs. There is another type of trend called the horizontal trend, and this is when there are a series of consecutive peaks and troughs that are at relative similar levels. Now, let's move on to a trend that traders hate because it would usually mean that they are not making any money or may even be losing money if trading options. In technical analysis, there are three types of trends. We have already talked about trends that move upwards and downwards, and now let's talk about trends that cause the stock to move sideways. So horizontal movement is also known as a trading range because the stock's price will be trading in a set price range. This is caused when the supply and demand are at equilibrium, so the price is relatively unchanged. Since there is no movement, many traders call this sort of trend trendless. Okay, let me help you visualize what I just said. As shown in this picture, we see that the portion of the graph in the blue circle is trading within the dotted lines. This would be the trading range of the stock. And traders usually hate this sort of price action because most technical analysis is designed for uptrends and downtrends. This means that the stock is just moving sideways, and technical analysis does not really perform when this happens. Therefore, in the end, traders have three options when navigating the market. The first option is to go long when there is an uptrend. The second option is to short the stock when it is on a downtrend. And the final step that many traders don't like to do is to do nothing. This last option is very important because forgetting this option exists will cause many traders to lose money. So let's look at an example that will help us visualize what I just said. Okay, so we see that in the first part of the graph, we see like some horizontal movement in the blue circle. This is easy to spot because the peaks and the troughs are at relatively the same levels. As we move on to the middle portion of the graph, which is circled red, we see an uptrend. So why can I say that we see an uptrend? We see an uptrend because point 3 is higher than point 1 and point 4 is higher than point 2. This supports the uptrend definition of consecutive higher highs and higher lows. The last part of the graph, which is shown in the green circle, we see a downtrend. Why is it a downtrend? It is a downtrend because point 6 is lower than point 4 and point 7 is lower than point 5. This supports the downtrend definition of consecutive lower highs and lower lows. Now that we're done with defining the three directions of a trend, let's move on to how to classify the three trends. If you watched my previous video on the Dow theory, you should be familiar with these three classifications or at least understand the concept as the timeframes may be different. If you haven't, I'll link the video in the description box below and watch the video as it goes in deeper in what I'm about to talk about. So in reality, there are an infinite number of trends and they can be categorized as anything as short as minutes to even years. However, traders usually classify trends into three categories, and the first category is like the major trend, and they usually last around 6 months. An intermediate trend will last weeks or a couple months. And the final type of trend, which is called the near-term trend, only lasts for 2 to 3 weeks. Technical analysts follow intermediate trends while using near-term trends to look for short-term setbacks so they could buy. Finally, let's move on to one of the most important topics in technical analysis, resistance and support. So the previous trough or the previous low forms the level of support. And levels of support means that under that level, there's more buying than selling, so the stock price would usually find it hard to dip below that level due to a lot of buying pressure. On the other hand, previous peaks or previous highs form resistance levels, and resistance levels can be defined as anything above that level where there's more selling than buying, so the stock price would have a hard time going over this level due to the selling pressure. I'll be providing examples later on so we can solidify what I just said, but until then, continue watching the video. For now, let's move on to the ideas of a reversal. So, in the start of an uptrend or near the end of the downtrend, reversals happen when the resistance levels are broken. By broken, I mean that the price will be hovering around the resistance level, but the price will eventually crack through and fly upwards. In the start of a downtrend or near the end of an uptrend, reversals happen when the price breaks through the support level. This means that the support level can't stop the huge selling pressure, causing the price to dip below the support level. Therefore, if we put these two definitions together, we can define an uptrend and a downtrend. In an uptrend, each successive support level must be higher than the one before it, or in simpler terms, the stock must form a higher high. This also applies to each resistance level, as each successive resistance level must be higher than the one before it, or in simpler terms, the stock must form a higher low. If these two events do not happen, then there may be a sign of a reversal, as the uptrend is weakening. Likewise can be said about the downtrend. If each successive support and resistance level is not lower than the one before it, which means that the stock is not forming a lower high or a lower low, this may signal that the downtrend is weakening, which may signal the reversal coming soon. Let's look at an example of what I just said. So a double top occurs when there is a reversal in an uptrend. And this happens when the stock can't break through a resistance level and forms a double top, causing a higher resistance level or a higher high to not form. This means that the stock will sell off as it can't maintain its upward momentum. The next example is called the double bottom, and this occurs when we see a reversal in a downtrend. This happens when the stock can't break through a support level, causing a lower support level or a lower low to not form. This means that the stock will start pumping as it can't maintain the downward momentum. Now, let's move on to the idea that resistance becomes support and support becomes resistance. So when does this happen? A resistance level becomes a support level when the price breaks through it and goes above the resistance level. A support level becomes a resistance level when the price is able to break through the support level and go below the resistance level. If you're confused by what I just said, don't worry. This example will help you conceptualize what I just covered. Here we see an image of Boeing. I drew a horizontal trend line to see where the prices seem to find support and resistance. Okay, let's start from the left and move our way slowly to the right. So the leftmost triangle is when we see the horizontal line change from a resistance level to a support level. This change occurred because price was able to break through it. The circle next to it shows that the horizontal line is still a support level, as we see the price not being able to break through that level. We can see this occur often as every time the price dips back to the horizontal level, it bounces back up. However, this changes when we reach the second and the third triangle of the graph. We see that the second and third triangle support gets broken, and the stock dips. At this point, the horizontal line briefly changed from being a level of support to a level of resistance, However, due to the strength of Boeing, this level of resistance gets broken at the third triangle and the horizontal line is now at a level of support. Now, let's move on to the circle next to the third triangle on the graph. We see that the circle shows that the horizontal line is still a support level, as price can't break through that level. However, once again, this changes when we are at our fourth triangle, and we see that price dipped below the horizontal line, and the rectangle that comes after it shows that the horizontal line now has become an area of resistance. Finally, after a few days of price dropping, if we move our attention to the cyan-colored circle, we see that the price is back at this horizontal level, and we see that the price has broken through that horizontal level, and the horizontal level has now become a level of support. Now that I explained how a level of support or resistance changes into one another, we must ask the question at what degree of penetration through that level can we say the swap truly happened. Many technical analysts state that a 3% above or below level causes the level to switch from a resistance level to a support level and vice versa. However, the book states that it is truly all relative. The final topic of this video is round numbers. So, what are round numbers? Round numbers are any numbers that are multiples of 5s and 10s. For instance, numbers such as 155, 300, and 275 are round numbers. These types of numbers are known to be like psychological support and resistance levels. Since trading has a human element to it, these numbers seem to have more significance than any other numbers. For instance, this can be seen in the gold rally in 1982 and 1987. We see that in 1982, the gold rally went all the way up to 500. Another gold rally happened in 1987, and we see that price peaked at $500 again. Even though the majority of trading is done by computers today, you can still see this phenomenon happen. So I thought that I might as well include it so you guys don't get caught on the wrong side of the trade. Now that we know about round numbers, how do we navigate around round numbers? If you listen carefully to these 4 rules, you'll be able to not worry about round numbers at all. So, if you have a short position, make sure you place an order just below the round number. For instance, if the stock is hitting the price of $80 and you want to short it, you would want to put a limit order at around $78 to $79 so that you're able to get into the trade 100% of the time. Because if you wait for $80, your order might not get filled. This is because that this number is watched by everyone else. For instance, if you know that at $80 it is a good shorting opportunity, then everyone else will know this too. This means that at $80, you could see sudden price fluctuations to the downside, and if your broker is not fast enough, you could miss out on the trade. As for long positions, you'd want to place an order just above the round number. The same logic applies because if you know that at $80 you would want to go long on a stock, there are other people who would want to do the same. So if you put your limit order at around $81 or $82, you could get into the trade at a better position because at $80 there will be an influx of demand for a stock, causing the price of the stock to go higher easily. As for your stop losses, you should do the exact opposite. So for your stop loss for your short position, you would want to put it above the round number. You would put the stop loss above the round number because the price tends to work its way towards the round numbers. Therefore, you'd want to avoid putting your stop losses at that round number so it doesn't get exercised right away. Likewise can be said about your long position. For your stop loss for your long position, you would put the stop loss below the round number. In the end, you should try to avoid round numbers for stop losses as price tends to linger around those numbers, and it may exercise your stop loss prematurely. Well, that's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of this channel. This video introduced the fundamentals of trends, support, and resistance. As for the next video, I'll be going over how to draw lines on a graph. So if you don't want to miss out, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports this channel. If you have any questions, leave a comment below and I will try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.